In an era where money moves at the speed of a click, the financial landscape is evolving faster than ever before. We find ourselves in a new age of finance, where borders are blurred and the traditional and digital worlds collide. Globalization, coupled with the accelerating pace of technological innovation, is driving this transformation, reshaping the very essence of how we interact with money. Take, for instance, the current trend among hedge funds, which are increasingly investing in private companies. Despite concerns about liquidity, these funds are betting big on the potential of these entities, a move that signifies a shift in investment strategies. They're venturing beyond the well-trodden path of public equities, diving into the less charted waters of private enterprises. This change, though fraught with challenges, opens up a myriad of opportunities for both investors and businesses alike. And it's not just the hedge funds. Traditional finance giants are also embracing the digital revolution. A prime example is Visa, a name synonymous with traditional finance, stepping into the NFT or non-fungible token market. With their recent acquisition of CryptoPunk 7610, Visa has signaled its readiness to adapt and evolve. This move, though surprising to some, marks a significant milestone in the integration of digital assets into mainstream finance. These are just a few glimpses into the rapidly changing world of finance. New technologies and global trends are constantly reshaping the landscape, creating a dynamic environment that demands adaptability and innovation. From hedge funds to Visa, everyone is learning to navigate this new age. The finance world as we know it is changing, morphing into a space where traditional and digital assets coexist and interact in ways we could only imagine a decade ago. The role of a company's leader is no longer confined to the boardroom. The dynamics of leadership are shifting, and the CEO's role is evolving at a rapid pace. In the past, the CEO's primary responsibility was to the company's shareholders, ensuring profitability and growth. Today, however, a CEO's role extends beyond the corporate realm, and they are increasingly focusing on societal impact. Consider the example of business leaders meeting with President Biden to discuss the potential economic consequences of a debt ceiling default. This isn't just about number crunching or strategic planning. It's about understanding the ripple effects of financial decisions on society at large. CEOs are now expected to be conversant not just in the language of business, but also in the discourse of social and economic issues. This evolution of the CEO's role reflects a broader shift in our understanding of what it means to be a successful company. Profitability is important, but it is no longer the sole measure of success. Today's CEOs are tasked with balancing the financial health of their organizations with their potential societal impact. They are expected to make decisions that are not only profitable, but also socially responsible. This isn't just a trend, it's a fundamental change in the way we do business. CEOs are increasingly seen as societal leaders, influencing not just the financial health of their companies, but also the broader economic and social landscape. They are expected to lead with empathy, understanding, and a sense of social responsibility. It's a challenging role, and it requires a new kind of leader. But it's also an opportunity. CEOs have the power to shape not just their companies, but also the world around them. Their decisions can have far-reaching impacts, influencing everything from economic policy to societal norms. In today's interconnected world, CEOs are becoming societal leaders, influencing not just the financial health of their companies, but also the broader economic and social landscape. Alternative assets are no longer the playground of the ultra-wealthy. Indeed, the landscape of investment is evolving, and alternative assets are at the forefront of this change. Traditionally, these assets like real estate, private equity, and private credit were the domain of the affluent. However, a shift is occurring, and these assets are now becoming more accessible to a wider range of wealth clients. Take, for instance, Merrill Lynch, a titan in the world of finance. They've recognized this trend and are making moves to accommodate it. Merrill Lynch has made the groundbreaking decision to lower the minimums for investments in these alternative assets. This is a significant development as it opens up new avenues for wealth clients who previously may not have had the opportunity to explore these types of investments. This growing popularity of alternative assets is not without reason. These assets offer a diversification of portfolio that traditional stocks and bonds cannot. They offer the potential for higher returns and can act as a hedge against the volatility of the stock market. Also, they can offer steady cash flows, as in the case of real estate and private credit. But as with any investment, these assets come with their own set of risks. These can range from liquidity issues to regulatory changes to the inherent risk of the asset itself. Thus, while the potential for high returns is enticing, it is crucial for investors to fully understand these risks before diving in. The rise of alternative assets is a testament to the evolving nature of the investment world. As these assets become increasingly mainstream, they bring with them a reshaping of the investment landscape. As alternative assets become more mainstream, they are reshaping the investment landscape, offering new opportunities and challenges for investors. This change is not just a trend, but a fundamental shift in the way we think about investing. And as we move forward, it will be fascinating to see how this evolution unfolds. The traditional 9-to-5 job is becoming a relic of the past. Welcome to the new world of work, where remote working is not just a temporary solution, but a long-term shift reshaping the finance industry. The digitization of financial services, spurred by the pandemic, has allowed many employees to work from anywhere. This change has its perks: no more commuting, more flexibility, and a wider talent pool for companies to choose from. It's a brave new world where geographical boundaries are no longer limitations. However, this shift isn't all rosy. With our homes becoming our offices, the line between personal life and work has blurred. The pressure to be always on is real. In the finance sector, where deadlines and market hours already contribute to long working days, this move to remote work can potentially extend work hours even further. It's like the office has moved into our homes, and it's not packing up and leaving at 5. What does this mean for the industry? On one side, it could lead to increased productivity. With more flexibility, employees can work during their most productive hours. On the other side, it could also lead to burnout. Without a clear distinction between work and home, finding a work-life balance becomes more challenging. This shift also raises questions about employee well-being. Are finance professionals equipped to handle this new way of working? How can companies ensure that their employees are not just physically safe, but also mentally healthy? As we navigate this new landscape, one thing is clear: the future of work in the finance industry isn't just about where we work, but also about how we work. It's about finding the balance between flexibility and overwork, productivity and well-being. As the boundaries between work and home blur, the finance industry is grappling with new questions about productivity, work-life balance, and employee well-being. This is the future of work, a landscape full of opportunities, but also challenges that we must navigate wisely. While the financial landscape is brimming with opportunities, it is not without its challenges. As we delve deeper into the financial world, we encounter a few hiccups that could potentially throw a spanner in the works. One such challenge is the regulatory issues looming over the buy now, pay later industry. This sector is growing at an unprecedented pace, but with growth comes scrutiny. Concerns are being raised over the lack of liquidity, merchant fees, and credit risks. The industry is at a crossroads where it must balance rapid expansion with regulatory compliance to ensure its sustainability. But this isn't the only challenge on the horizon. Cryptocurrency, the digital gold rush of the 21st century, also faces potential hurdles. The introduction of an electronic dollar could put the valuation of cryptocurrencies in peril. As we've seen with Elliott Management's prediction of an electronic dollar, this could potentially devalue cryptocurrencies, shaking up the digital asset market. Moreover, the role of the CEO is evolving. with a newfound emphasis on societal impact. This shift requires a delicate balance between profitability and social responsibility, a challenge that will test the mettle of many a leader in the finance sector. In the midst of these uncertainties, one thing remains clear: the financial landscape is not what it used to be. The rules of the game are changing, and those who fail to adapt may find themselves left behind. As we navigate this new financial era, the ability to adapt and innovate will be key to overcoming challenges and seizing the opportunities that lie ahead.